Kevin, the Bank of Canada exceeding expectations, I guess, and raising that overnight benchmark rate to 2.5%, going up a full percentage point. You were just listening in on that press conference by Governor Tiff Macklem. What are some of the key takeaways that led to this decision?
Right, Larysa, definitely, as you noted, a surprise. The Bank of Canada opting for shock and awe here to get a message across that it is serious about getting inflation under control. And I think the new inflation expectations were probably the main trigger, the thing that the Bank of Canada governor and his team saw that prompted them to jump out in front of all the other global central banks. I mean, every central bank is fighting with a similar inflation problem. None have gone at it as aggressively as the Bank of Canada has today, with a full percentage point increase at one go like this. And those forecasts, I mean, they came in showing that inflation is destined for 8% or higher, sort of through the summer into the fall, according to forecasts. I mean, that goes against everything that the Bank of Canada thought would have been happening by now. It was certainly had recognized that inflation had jumped to an uncomfortably high level, but I think it kind of assumed that by now at least it would start to move in the other direction, and in fact it's continuing to accelerate. So the Bank of Canada had to, as we said, had to jump in, or at least felt it did, to do something to make sure people understood that this was not going to be the new reality, not going to become a new reality, want to correct expectations to in fact help it down the road. So if those expectations don't root, if the public accepts or receives the message today and understands that, okay, the Bank of Canada won't let 8% become the new constant for inflation, then I won't ask for a wage increase of 10%, or, if I'm a company, I won't add a 10% premium onto whatever I'm selling. That's what the Bank of Canada is trying to avoid. So we'll learn in a few months whether it works or not. If it doesn't work, the central bank's probably not going to have much choice but to go that much harder, and then the path to a soft landing will become that much narrower. The governor acknowledged during the press conference that that path has narrowed, in part because of today's move. But he said the reason he did it was to, in fact, reduce the odds of him having to actually induce a recession to get inflation under control down the road. So yeah, I mean, it's a big surprise, and I guess we'll learn over the summer whether it worked.
I was only able to catch the tail end of that presser this morning, and somebody had brought up forecasting errors, and I guess what the bank has learned thus far and going forward.
Yeah, so the Bank of Canada took some time during the past few months to try to see where it went wrong, because as we know, it's had a hard time pinning down what's going on with inflation. So 2 points to that. I mean, so just a general rundown of what the Bank of Canada discovered. I mean, it saw that a good percentage of the inflation was kind of what we knew, all these various international shocks over which it has very little control. Commodity prices, most recently related to the war in Ukraine, of course, the supply chain issues, odd things that no one would have really expected, certainly in regards to the war. You would have had to be the equivalent of a geopolitical super forecaster to really have been sure, say, a year or so ago, that something like this was going to happen. So that wasn't on anybody's radar when the Bank of Canada and others were trying to project a path out of the pandemic recession. And then the supply chains, again, it was something that people could see was a problem, but you'd assume that the companies would have sorted it out, certainly by now. But that's just not happening for various reasons. So those were sort of the biggest factors. I guess the other thing that happened, the other thing that the Bank of Canada discovered, is that they didn't have a good handle on how much demand they were creating at the same time, or how much demand was building up in the economy. Their models just didn't anticipate the sort of rush households had to purchase goods while cooped up during the pandemic. They just didn't anticipate those kinds of things happening. So those are the sort of the mathematical, the mechanical reasons the forecast didn't come together. Not a lot of qualitative assessment, though, about whether there were other indicators, other things that the central bank could have been or should have been taking into account during this period that might have allowed them to maybe weigh different sort of judgments on what the models were telling them. Perhaps some judgment errors were made. That didn't really come through. The governor and the senior deputy governor, Carolyn Rogers, sort of dodged that question. So this issue is probably far from over. Lots of economists out there have questions and critique about how the Bank of Canada and the other central banks, frankly, have handled this episode. So there's more to come there, Larysa, for sure. It's still, I think the public's going to want to see that the Bank of Canada, and again, the other central banks, I don't want to make this all about the Bank of Canada, but we're talking about the Bank of Canada. I think the public's going to want to see that the Bank of Canada has learned something from this episode. So, look for some more elaboration from the central bank going forward on just what they've learned from this period.
One of the surveys from the Bank of Canada have suggested that, I guess, consumers and business expectation is that inflation is going to be higher for longer. We're now in this neutral rate. Is it enough to, I guess, is it enough to restrain? Is it enough to not overstimulate? Where is the expectation now? We've talked a little bit, you've mentioned inflation expectation. Does the bank do a pivot next year? How high are we going with this rate? And next year, are we going to see a pullback?
Yeah, well, so the short answer, Larysa, is probably not quite enough. And the Bank of Canada said as much today, saying, look, there's more to come, quite likely. So the neutral rate, again, should underline the fact that it's kind of it's a theoretical thing, a wide margin or a wide zone in which the Bank of Canada, sort of best guess on what an interest rate setting would be that neither sort of hinders or helps the economy grow. So you're right. We've entered that zone of 2% to 3%. So really, all the central bank, though, has done at this stage, now that we're in this neutral setting, that's neither helping or hurting, is just taking the foot off the gas. And those inflation numbers make it look like the central bank's going to need to pump the brakes at least, if not hit them. So quite likely, I think again things could change, but I think there's every reason to think that the benchmark rate is going to have to at least get to the top of that neutral rate estimate of 3%. And again, if we assume that estimate is correct, if that's useful gauge for how the economy works, then we're going to have to go beyond 3% to rein in inflation. So there's probably every reason for people to expect that benchmark rate could creep up to 3.25, 3.5, maybe even higher if we don't see a shift in the inflation numbers soon.
I know you've been all about the Bank of Canada today, but inflation numbers coming out of the US this morning suggesting that June hit 9.1%. We know that what happens in the US economy, kind of Canada's economy follows. How do you see that? And we haven't even talked about recession yet. How do you see those inflation numbers in the US affecting what's happening here, and ultimately, will this push us into a recession on both sides of the divide?
I'll give you two answers to that, Larysa. So, I mean, I think maybe, and this might be something of an odd answer, but I think that new inflation number in the U.S. is going to first affect Canada this way. I mean, there's probably little doubt now that the Fed, for a change, is going to follow the Bank of Canada and probably do a full percentage point increase of its own the next opportunity it has. That's on the margin unhelpful for the Bank of Canada, because I think one of the things that policymakers here in Canada were trying to achieve today is get something of an interest rate differential between Canada and the U.S. so as to put a little upward pressure on the exchange rate. An odd thing that the Bank of Canada observed in the section of its latest report on the economy, where it got into the forecasting mistakes it made, was it didn't anticipate, and frankly, based on historical evidence, there was no reason to anticipate that the dollar wouldn't go higher along with oil prices. I mean, that's always happened in the past. There's always been a tight relationship between those two prices. Well, oil prices, as we know, took off, but the currency didn't really, sort of just continue to trundle along sort of where it has been for the last little while. That's made it more difficult to get inflation under control, of course, because it makes imports that much more expensive. So I think one of the things the central bank was trying to do today was, again, play with the exchange rate. Not that they were targeting the exchange rate, but certainly recognizing the fact that the positive interest rate differential between Canada and the U.S. would put some upward pressure on the currency, and on the margins at least help with the inflation fight a little bit. Now, if the Fed follows the Bank of Canada and basically evens things out, it takes away whatever boost we might have gotten from a stronger currency down the road. So that's one way to answer the question. And then the other one, of course, Larysa, is when you're looking at inflation pushing toward like double digits. I mean, they're going to find that so alarming. It's going to hurt confidence in the U.S. The central bank is going to have to continue to ramp up interest rates. Some will argue that perhaps they've gotten a little bit ahead of themselves down the U.S. They've got every reason to think, seeing inflation numbers like that will make them that much more aggressive. And then, the chances of a soft landing become less and less. So absolutely, if the U.S. is willing to risk a recession, and Chair Jerome Powell, the Fed, has said that he's in fact willing to do so, we're not going to escape that. So, a recession in the U.S. would probably, really kill the chances of Canada also avoiding one. So we most likely would get sort of dragged along with the U.S. if that was to happen.